Yeah, markets had a bit of a reprieve on Friday. Took some solace from Powell being upbeat on the economy, but over the weekend, um, this interview with Trump that was recorded on Thursday last, but played out over the weekend, where he was asked about whether or not his policies could send the US into recession. He declined to answer the question, and as we say in Ireland, not as good as a wink to a blind man. His lack of an answer was taken by markets to mean yes. And at the same time, we had his Treasury Secretary, Scott Bessant, talking. Please put yourself on mute if you don't want to talk, so just put yourself on mute, or I will. So yeah, we had Bessant over the weekend as well, talking about the economy needs to detox, it needs to wean itself off Biden era stimulus, essentially is what he was talking about, and that may come with some pain. So we have his quote a little bit later, but he talked about potentially the legacy economy could roll over slightly. So there's still very much feel I think they have the runway to blame the previous administration for anything that is going wrong at the moment, despite the fact that most of the reason markets are rolling over and uncertain is really nothing to do with what happened in the previous administration. It's all to do with the uncertainty that Trump's trade policy and the uncertainty that what Musk and Doji are doing around employment. Uncertainty is what's weighing on markets here, as we talked about last week, and I've been saying for the past 2 weeks. Really, markets are very fragile. Here, uncertainty is high, and when uncertainty is high, risk assets tend to underperform, which is just what we've seen over the last week or so. This sort of pattern of sell-offs followed by rallies, followed by consolidation, and then just selling off. Yesterday was a little bit different. You can see just from this chart how different it looks. It was, rather than most of the sessions before, we've had a sell-off and a rally, or we've had a rally and a sell-off. So we've had a market that sort of shifted direction intraday as buyers and sellers took over. Monday was just selling. It was just literally selling all day, all the way down to here. At one point, the market was off 3%. I think it was 3.3% was the low on the day, and then we bounced. And we bounced a pretty heavy volume. You can just about make out the green bar there. Maybe you can't, but that was a really big buy imbalance on the close. It just took a bit of a tumble in Asia, but since then, we're sitting up here, up about 30 basis points from yesterday's close. So too early to call the turn, but yesterday we certainly had some of the characteristics of a market that's bottoming. This is just the heat map from yesterday. Obviously, Tesla getting absolutely destroyed. It wasn't completely red. Some areas, beverages, energy, utilities, some healthcare was green. So again, it wasn't a complete sell everything markets, and it hasn't been that way over the week. It's been really the selling has been quite concentrated within the tech names and the financials. So the sort of year to date, last year's winners being sold, and some of the losers being bought. So again, a rotation rather than a complete dumping. And if we look at the ETFs, we can sort of see that where the greens here are the inverse levered ETFs, by the way. That's why they're very green. But most of the red coming from the US, and most of the green coming from non-US emerging markets, China, Europe, global, GDX, the gold miners, some of the precious metals. So again, it's been a movement of capital out of the US to some extent. It's been a market where this is just showing you the momentum factor. So momentum, you can think of momentum as a basket of stocks where you're long the winners and you're short the losers. So you're long the stocks that are going up and you short the stocks that are going down. And it's called momentum because it tends to make money if the winners keep on going up and the losers keep on going down. So you're long momentum. The performance of momentum this year has been the worst start to a year for momentum for 10 years. And interestingly, last year was the best start to the year for 10 years for momentum. So the winners, it's clear therefore that the winners are being sold and the losers are being bought. And again, I said at the start of this year, echoed what a lot of the banks were telling their clients, which is 2024 was a year where you could just buy the markets, and 2025 you need to be selective. Which market, which stock, which country. It's not a buy the market anymore. And this, I think this just backs up this point. This is the beta factor performance. Beta being the movement of a stock's price due to the market. If you think that, on any given day, the share price of a stock moves because of what's news about that stock, something fundamental to that stock. But it also moves because the broad market is just going up and down. A day where, like yesterday, where the S&P is down 3%, pretty much all stocks are down. It's not because there's particularly bad news for those stocks. It's just the market, the beta drags them down. So again, the worst start to the year for beta in US markets in 10 years. Well, actually 2020 was worse. And we all know what happened in 2020. So hopefully 2020 is not the analogy that we're going on. Interestingly, in currency markets, no real stress in those tariff affected crosses, like the dollar versus the Canadian dollar, the dollar versus the Mexican peso. These spikes in the past were on tariff news, but you can see the spikes are quickly sold. So while the broad market may be reeling a little bit from tariff uncertainty and worrying about trade wars, we're not seeing it impacting the currency. We're not seeing macro traders take big currency positions because of it. And again, maybe that's a positive. There's obviously been a big reset in euro dollar, but that's more because of what Germany and Europe are doing with defense spending, and Germany stepping away from its debt brake. Of course, some could say that's directly a result of what Trump's policy towards Russia and Ukraine. Whether or not that's intended or not, I don't know. But again, that's one thing at the margin. This very strong outperformance of European assets has also sucked money out of the winners in the US. In the commodity space, we called it a breakout of copper a while ago. That still continues to work quite well, off the highs a little bit, but it's still looking pretty good. Gold sold off a bit into last week, but it's popped higher again. One would expect keeps on going up. Big dollar, lower interest rates, all good for gold, and uncertainty, all good for gold. Oil, very much underperforming. It reached a high in early February, but it's selling off since then, in part due to OPEC and also just growth fears. And those growth fears, I think, are because of this. This is showing you in the red line what we call supplies index. So it's just looking at, this red line will go up if the data, the macro data, like the jolts today, so on and so forth, payrolls last week comes in better than expected, the red line goes up. If it comes in worse than expected, it goes down. So what's been happening for most of this year has been the growth data of the macro sort of data sets has been coming in largely worse than expected, and the inflation data has been coming in better than expected. It's surprised to the upside, but of course that's not a good thing for markets. So inflation has been beating expectations to the upside. Growth has been missing, and that's why you will hear more and more discussion and mentions of recession. It's why the interest rate market has gone from pricing just one cut to pricing 3 this year in the space of, 2 weeks. That's pretty significant. even though Powell pushed back on that on Friday. Again, I thought the strange market didn't react to that, but maybe it is just this focus on tariffs and what they mean for the economy. We've seen this picture before with Trump, both with the market and with the dollar. Very similar picture in 2016, where initially markets went up, the dollar went up, and then it rolled over as trade wars landed, before finally rallied. So this chart is just showing you we're underperforming versus Trump 1.0 on tariff 2.0, but I think that's reasonable, just given the fact that tariffs this time around are a lot more significant. As I said before, the retail community have been selling aggressively, and we'll see a chart on that later. The hedge funds have been selling pretty aggressively, and the systematic investors in the market have also been aggressively selling. The long onlys, the pension funds, the big institutions, largely doing nothing, de-risking a little bit. And maybe one reason why is while this economic data surprise index has been falling, and we call this soft, largely soft data, the earnings per share in the S&P is largely flat. A little bit of a drop off in the last earnings season, but it's going back up again. So this is one thing those sort of fundamental, longer term, long only investors will be watching. If that green line starts to turn down, then yeah, they may start selling. But while it's up here, they're still reasonably confident that markets are in a good position. But the tone has changed. This is a survey, Goldman Sachs. A lot of the banks do these sort of snap surveys of their clients just to sort of take the temperature of where things are and what they're doing and what they're thinking. And this is one from Goldman's that was just done last week, maybe even yesterday, exactly when it was done last week. Just showing that people are more bearish in terms of what's the favorite asset class. It's gold is becoming more favorable, bonds are becoming more favorable, equities becoming less favorable. No surprise there. And that, again, at the margin, that supports gold going forward. A big flip-flop in sentiment from 73% of people being bullish in November, just post-election, to 55% bearish now. So again, that big sentiment coming into the start of this year, and when I was talking to you guys 2 weeks ago, one of the reasons the market was vulnerable was because we'd seen huge retail buying. Sentiment was really overextended. You know, you had people buying Palantir at $124 and an RSI of 90. You just had that sort of irrational exuberance happening. And we were coming into the worst seasonal period for markets of the year. So the stars aligned in a bad way for markets, but maybe sentiment has definitely shifted now. Positioning has shifted. I think where we are at the moment, we'll see a little bit later from a technical point of view. One could certainly imagine markets could bounce from here. I think from a fundamental point of view, there is just more concern growing around U.S. growth and whether it's something that's the cost cutting that's happening, the drop in federal spending that's going to be happening, and the Fed not cutting interest rates anytime soon because of inflation is potentially going to be a big problem for the U.S. economy. So you see a lot of these notes from the banks cutting their growth forecasts, increasing their inflation forecasts. These are the comments from Scott Bessant at the weekend. Not what markets wanted to hear at all. There is no Trump put, but there's a Trump call. The inherited economy, not our fault, could start to roll a bit. And there needs to be a detox period. So it's very the opposite of comforting words from the Treasury Secretary, basically saying that you need to before things are going to get better, you need to take your medicine. So I think his message was the beatings will continue until morale improves. That's definitely not what the market wanted to hear. It's one of the reasons why we sold off so aggressively yesterday. And just this uncertainty index remains extremely high. One of the other things that happened last week that wasn't great for markets or risk generally was a really big move in German bond yields. We had the, say really big, it was the largest move in 10-year yields in Germany since reunification. These sort of large moves up in bond yield mean price is falling. So if you think of it, holders of German bonds, which are the likes of big institutions and pension funds in Europe, took a massive hit last week because the price of their bonds dropped the most that it has done for 30 years, which they definitely would not have been modeling in their risk models. So that was pretty painful for a lot of those guys. Could have driven further de-risking out of the US. I think again that's just something that piled on the pressure into the end of the last week and may still be rippling through. The dollar is all the way back to where it was pre-election. Mag 7 are no longer the leaders. It's now European banks that are the best performers over the last year. And S&P and stocks are through big technical levels. We've got that 20-day crossing the 100-day, a clean break of the 200-day. And we're now sitting down around these levels. It remains to be seen whether or not we can get our head back above water today. We'll wait and see. VIX has moved higher, but in a relatively orderly way. It hasn't been like August, where we had a very sharp spike, and then it came all the way back down again. It's just been trending up. Note the levels here. VIX is not at 28. Well, VIX is, but you can't trade VIX. The VIX futures are the only tradable instrument for VIX, and the VIX futures are also what the ETFs trade. So the real level of tradable VIX is 23. It is not 28, and therefore I don't think it's particularly high here. And I think it could go higher. And this is just showing you what I mean by that. This the VIX index at 28, but the futures are actually at 23. And I think that you hear a lot of VIX mean reverts, so when it gets to 20 you should sell it. Well, one needs to be cognizant of what regime we're in for volatility. There are certainly times where VIX oscillates in this range, which is between 10 and 17. There's equally times where it is 17 to 20, and there's times when it's like 20 to 30. So we've been in this sort of middle volatility range recently. We've come out of the very low range, and I think we're going back into the high range. So again, VIX is not a sell here, and it's certainly not something to play around with if you don't understand options, because it's a derivative on a derivative. Makes it as complicated as that sounds. So a VIX option is an option on an option. And if you're not very comfortable with options, then trading options on options is something best avoided. So keep an eye on VIX, but as a signaling mechanism, and just VIX higher should be a signal to take risk off, or rather, any new risk you put on should be at a smaller size. So that's I would use VIX. Moving on, the sort of steepness of the VIX curve, it is steep. This idea that the term structure tends to go, this is normal for VIX, where the futures are sloping upwards. In periods of stress, it flips to this, where the front month futures are higher than the back month. So we often look at this ratio of 2-month to 8-month VIX to signal stress, and it's popped, but again, nothing like it was in August, so still plenty of room for VIX to go higher. Gamma, I won't spend too much time on that, but we are in negative gamma for markets. That just means that at the margin, if markets are falling, the market makers, the dealers, are selling rather than buying, and vice versa. If they're going up, they're buying rather than selling. So it works both ways. It's not negative in the sense that it can help add fuel to the fire of a short squeeze, but it also means that when we get days like yesterday, market makers are not stabilizing the market. They're part of the problem. Another part of the problem are leveraged ETFs, which have shot up in popularity recently. For for not very rational reasons. But anyway, but what happens with these guys is that they need to rebalance at the end of the day, and they tend to again sell if the market is falling. They're sellers, and if it's rising, they're buyers because they need to maintain their leverage ratio. The fact that they're so much bigger these days just means they're adding a lot, again, adding volatility to the market when it has big moves. The leveraged ETFs are making the moves bigger, is a way to think about it, particularly on stocks like those Mag 7 stocks, where a lot of sort of single name leveraged ETFs sit. The other kind of player in the market that's been important recently that I've been speaking about are what we call the CTAs, the commodity trading advisors. They're basically funds that trade trends. So if it's in a market's in an uptrend, they're buying. If it's in a downtrend, they're selling. I was pointing out recently that these guys were super long. They were at their, again, that was one of the risks that we had. They were at max crowded long recently. But now actually with the sell-off yesterday, they're now actually in max crowded shorts. So the CTA position has gone from almost max long to short. So these guys were a risk because they had about $80 billion to sell of S&P over the last 2 weeks, but they've done this selling. They've finished. The expectation is that even if S&P goes lower, they're not selling anymore. And if it even goes up a little bit, they could be buyers to the tune of 20 to 40 billion. So again, at the margin, the systematic funds have turned from being a negative for the market to a potential positive. The other bright spot, I suppose, is we are extremely oversold, depending on lots of different ways to measure oversold. You can look at RSIs, you can look at distance from the 50-day moving average, but whatever way you cut it, we are extremely oversold here. This is just a chart from these guys' macro charts that I follow, and they've got a sort of more sophisticated model to look at overbought, oversold, and they just flagged this morning that we are at some of the most oversold levels that they've seen. So we're more oversold than August, October 2022, which was the bottom of the bear market, the COVID bottom, the volatility panic in 2018, and the 2011 euro crisis. It was worse in 1987, but not much. It is worse than LTCM, and it is not as bad as 2008, which is the most oversold in history. But we all know what happened in 2008. We're certainly not in that world. So only one of those oversold signals was not a market bottom, and that was 2008, of course. That doesn't mean the market's going up from here, but again, at the margin, it just tells you that we've traveled a long way, and typically when markets are oversold, they can stay oversold for a while, but it tends to be a signal that there might be a short-term bottoming happening. The other signal that they're pointing to is just the flows out of stocks and into cash have been significant, and you tend not to get these moves at the start of the bear market. They tend to be more towards the bottom of a bear market. So again, this sort of behavior of selling, I'm going to sneeze, sorry. Selling out of stocks and into cash. Something's been going on for most of this year, is again something that tends to be supportive of a market that's maybe finding its feet. Sentiment is swung from positive to negative. As you can see, as I mentioned on the RSIs, a lot of stocks sitting at 30, Tesla, no surprise, sitting at 20 on its RSI. NASDAQ is below 30. Russell in the mid-20s. Pretty much anything you look at is flagging oversold. But a word of caution, set up at the moment is not dissimilar to this. One could mistake that for the last year of S&P. It's not. This was 2022. Had a very similar rally coming out of COVID, where the 200 was not touched, and we had a couple of breaches of the 100 and a rally back. You had this sort of congestion period into the end of the year, one new all-time high before it started to roll over into 2022. This was 21, this is 22. And very similar to today, actually, where we breached the 200s and then we bounced. What happened after that wasn't such a pretty picture. We did manage to get back above the 200 again. So we had these sort of face ripping counter trend rallies of between 7 to 10%. But once the 200 went for the third time, we traded down about 18%. Another big counter trend rally got us above the 200. But that was a false breakout, and we went back to put in the all-time lows that year in October before gradually moving out of it, and then the current uptrend starts just over here with the moving average crossover. So the risk for markets here, even if we do get a bounce, is that if we are going into risks arising of a US recession, then it could look more like 2022 than 2015, which is, I suppose, the more positive picture where we got this sell-off and then a bounce, but of course then it did drop further after that. So a few historical analogies, it's mixed. But from a seasonality point of view, we often do get the lows around about this time of the year. Second week in March is often the seasonal low for markets. This is what I was pointing out a few weeks ago, that we were in a dangerous period for stocks because it was seasonally weak. But we're now in one of the most, we will be getting from about the 14th of March into one of the most positive seasonal periods for markets. And remember, all of those corporates have got plenty of buybacks to do, and they'll be much more incentivized to buy back their stock at these levels. Interest rates lower, dollar lower is good for the US economy. Should help boost export and manufacturing, get the deficit down. It'll remove worries of that $3 billion of debt that needs to be rolled over this year. So it's not all bad news, but we are very data dependent here. We've got jolts coming in today, so that's labor market data. Tomorrow we've got inflation data, and we'll be looking for a number. Job openings that is in line, that is not below. The low number here would be negative. And with inflation, again, we're hoping for basically in-line numbers. Any lower than expected numbers would be very positive for markets, and that could be the start of a short squeeze tomorrow before we go into next week, which is the Fed. And maybe the contrarian indicator, that is the front page of The Economist, will work again as they have this very negative outlook of Trump burning it all down. So we wait and see, but I don't want to call a turn here just yet, but I do think that there's potential, more so than there has been over the last 2 weeks. We could potentially see a short-term market bottom and even potentially a short squeeze.